Hi there. In this video, we'll tackle real exam-style questions, explain the right answer, break down the wrong ones, and give you some tips to lock it all in. Now, without further ado, let's start with question 1. Question number 1. Who regulates real estate licenses in California? A. California Association of Realtors. B. California Real Estate Board. C. California Department of Real Estate. D. Real Estate Education Commission. The correct answer is C. Here's the deal. In California, the agency in charge of licensing, enforcing rules, and making sure real estate professionals stay legit is the Department of Real Estate, or DRE. They're the ones who approve applications, investigate complaints, and hand out disciplinary actions when needed. If you're getting a real estate license in California, you're going through them. Now let's talk about the wrong answers. Sounds familiar. And yes, the California Association of Realtors is a big organization, but it's just a trade group. It supports agents, offers resources, but doesn't handle licensing or discipline. B might sound official, but there is no such thing as the California Real Estate Board. That one's a trap. And D, the Real Estate Education Commission isn't a real licensing authority either. It doesn't regulate anything in California. So remember this. If it's about licensing, discipline, or exams, the DRE is your go-to answer. Question number 2. Which document must be given to buyers of properties built before 1978? A. Mello-Roos Notice. B. Natural Hazard Disclosure. C. Lead-Based Paint Disclosure. D. Agent Inspection Report. And the correct answer is C. Here's why. Homes built before 1978 may contain lead-based paint, which is a serious health risk, especially for young children and pregnant women. That's why federal law requires sellers to provide a lead-based paint disclosure for any residential property built before that year. It's not optional, and skipping it can lead to legal trouble. Now for the wrong choices. A. The Mello-Roos Notice deals with special taxes in certain new developments, totally unrelated to old paint. B. The Natural Hazard Disclosure is a California-specific form that talks about things like earthquakes and floods. And D. The Agent Inspection Report is something the agent does as part of their duty, but again, it's not the required federal document for this situation. So here's the trick. When you see the phrase before 1978, your brain should shout the phrase lead paint. Let's move on to the next question. Question number 3. What is a Transfer Disclosure Statement, TDS? A. A report from the agent. B. A disclosure of commission rates. C. A form for zoning issues. D. A seller's property condition disclosure. And the correct answer is D. Let's check the other options. A might seem close, but it's not right. Agents do help review and complete the TDS, but it's the seller's responsibility to disclose what they know. B talks about commission rates, which are between brokers and their clients. That has nothing to do with the property's physical condition. With option C, zoning issues go in other types of disclosures. The TDS is all about what the seller knows is physically wrong with the home. If you see TDS, think the seller tells what they know. The good, the bad, and the ugly. Question number 4. What happens if a seller refuses to provide the transfer disclosure statement? A. The sale continues without issue. B. The buyer must waive rights. C. The sale becomes voidable by the buyer. D. The seller can delay indefinitely. The correct answer is C. Under California law, the buyer has the right to cancel the sale if they don't receive the TDS within the required time. It's not just a courtesy, it's a legal obligation. The idea is that buyers need to know what they're walking into before finalizing the deal. Let's look at the wrong ones. A is incorrect because failing to provide the TDS is a violation, and the sale can't just move forward like nothing happened. B is wrong because buyers don't have to waive their rights. In fact, they're protected by law in this case. D, no way. Sellers can't just drag their feet forever. There are deadlines, and if they miss them, the buyer gets a way out. Question number 5. What is a Mello-Roos tax? A property tax deduction. B, a flat rate HOA fee. C, a special district tax. D, a mortgage penalty tax. The right answer is C. Mello-Roos taxes are special assessments used to pay for public improvements in newly developed areas, like roads, schools, or fire stations. If you're buying in a brand new subdivision or master-planned community, chances are Mello-Roos will show up on your property tax bill. Now let's clean up the wrong choices. A deduction sounds nice, but Mello-Roos is actually an extra charge, not a savings. B is incorrect because HOA fees are separate from taxes and paid to the homeowners association, not the government. How about D? A mortgage penalty is a totally different concept and has nothing to do with this kind of tax. Here's an easy way to remember it. Mello-Roos is about a new neighborhood. Question number 6. What is the purpose of the natural hazard disclosure in California? A, to disclose mold risks. B, to explain loan terms. C, to provide appraisal value. D, to inform about flood, fire, or earthquake zones. The correct answer is D. In California, sellers are required to give buyers a natural hazard disclosure, often called the NHD. If the property is located in certain hazard zones, these include flood zones, fire hazard severity zones, and earthquake fault zones. The idea is to let buyers know what kind of natural risks they're taking on before they buy the property. Let's go through the other options. Sounds concerning, but mold isn't one of the specific hazards covered under the NHD. That might show up in a different type of disclosure or inspection. B is unrelated. Loan terms come from the lender, not the seller, and have nothing to do with natural hazard zones. C is also off track. Appraisal value is determined separately and isn't the purpose of this disclosure. So here's your takeaway. If it involves earthquakes, wildfires, or floods, that's where the NHD steps in. Question number 7. Who must sign the transfer disclosure statement? A, only the seller. B, only the buyer. C, only the broker. D, seller, listing agent, and buyer. The correct answer is D. The transfer disclosure statement, or TDS, needs signatures from all 3 parties. The seller, the listing agent, and the buyer, each one plays a role. The seller discloses known issues, the agent confirms their visual inspection, and the buyer signs to acknowledge receipt. Now, let's look at the wrong answers. A is incomplete. While the seller is the main person responsible for disclosing issues, they're not the only one who has to sign. B is also incomplete. The buyer signs to acknowledge the disclosure, but again, that's just one piece. C is not enough. The broker or agent has to sign based on their inspection. But that doesn't replace the need for the seller or buyer's signatures. So remember this simple rule, that is, the TDS is a 3-signature document, no shortcuts. Question number 8. Which agency enforces fair housing laws in California? A, Department of Housing and Urban Development. B, Department of Consumer Affairs. C, California DRE. D, Department of Fair Employment and Housing. The right answer is D. In California, the Department of Fair Employment and Housing, often called DFEH, is the main agency that handles fair housing violations. They investigate complaints about discrimination in housing based on race, religion, disability, family status, and more. Let's clear up the confusion on the others. A is a federal agency. HUD does enforce fair housing laws nationwide, but in California, it's the DFEH that handles state-level enforcement. B sounds relevant, but the Department of Consumer Affairs isn't in charge of housing discrimination cases. C, the California DRE, regulates licensing for agents and brokers, but it does not enforce fair housing laws. So if you see a question about discrimination enforcement in California, Think DFEH, and that's your answer. Question number 9. Which type of tenancy is presumed unless otherwise stated in California? A. Joint tenancy. B. Community property. C. Tenancy in common. D. Life estate. The correct answer is C. In California, when 2 or more people take ownership of a property, and the deed doesn't specify how they're holding title, the default assumption is tenancy in common. That means each person owns a share, and they can sell or will their interest independently. Let's break down the other options. A includes the right of survivorship, but it must be clearly stated in the deed. It's never assumed. B. Community property only applies to married couples or registered domestic partners, and it still has to be specified in the title. D. A life estate is a special type of ownership with very specific terms. That's not something the law assumes by default. So here's a quick memory tip. If the deed is silent, it defaults to tenancy in common. Question number 10. How long must brokers retain real estate transaction records in California? A. 1 year. B. 2 years. C. 3 years. D. 5 years. The correct answer is C. Brokers in California are required by the Department of Real Estate to keep records for 3 years. This includes everything from contracts to disclosures and even emails related to the transaction. The time starts ticking from the date the transaction closes or from when the listing agreement ends. Let's go through why the others are wrong. A is not enough time. 1 year wouldn't even cover most audit windows. B is still too short. D might sound safe, but 5 years isn't required by law. It's more than necessary unless it's for tax or legal purposes. So your magic number is 3. 3 years to retain real estate transaction records. No more, no less. Question number 11. A seller prepaid annual property taxes of $4,800. What is the prorated amount to credit the seller if the sale closes on September 30th? A. $1,600. B. $1,000. C. $1,200. D. $800. The correct answer is C. Here's how to think about it. Property taxes are usually paid annually, so we need to calculate how much of that payment covers the months the seller will not own the property anymore. If the sale closes on September 30th, that means the seller already paid for October, November, and December, which is 3 months that belong to the buyer now. We take $4,800, divide it by 12 months, and multiply by 3. That gives us $1,200, which is the amount the seller should be credited back at closing. Let's look at the other choices. A is too high, that would be crediting the seller for 4 months. B is too low. $1,000 only accounts for 2.5 months. D is also too low. $800 would only cover about 2 months. So the trick here is simple. Watch the closing date, count the months left in the year, and prorate accordingly. Question number 12. What is the area of a rectangular lot measuring 150 feet by 200 feet? A. 20,000 square feet. B. 25,000 square feet. C. 30,000 square feet. D. 35,000 square feet. The correct answer is C. This is a classic math question. Area equals length times width. So you take 150 and multiply it by 200. That gives you 30,000 square feet. No tricks, no conversions, just straight multiplication. Now let's look at the wrong answers. A is what you get if you accidentally multiply 100 by 200. B might come from guessing or dropping a 0. D is just too high. Maybe someone mixed up their numbers. So the takeaway is this. For the basic area, it's always length times width. Stick to the formula, and you will be just fine. Question number 13. A property has a net operating income of $50,000 and is valued at $625,000. What is the cap rate? A. 6%. B. 7%. C. 8%. D. 10%? The correct answer is C. Cap rate, or capitalization rate, is a formula used to measure investment returns. The formula is net operating income divided by property value. In this case, 50,000 divided by 625,000 equals 0.08, or 8%. Let's check the other options. A is incorrect, which would be correct if the income was 37,500. B is too low because the cap rate assumes a higher property value than 7%. D is too high, that would be a cap rate for a much lower property price. So remember this. Cap rate equals income divided by value. It's a quick way to see how much return a property generates. Question number 14. What is the role of the real estate commissioner in California? A. Appointing brokers. B. Issuing deeds. C. Enforcing real estate laws. D. Approving construction permits. The correct answer is C. The real estate commissioner is the head of the California Department of Real Estate. Their job is to oversee licensing, investigate complaints, and enforce real estate laws. If an agent breaks the rules, the commissioner can take disciplinary action. They make sure the industry runs fairly and legally. Now for the incorrect answers. A sounds official, but brokers are not appointed. They earn their license through exams and experience. B is way off because deeds are handled by county offices, not the commissioner. D is more of a city or county job. The commissioner does not handle construction permits. So here's the big idea. The commissioner is like the referee of real estate in California. They keep the game fair and the players honest. Question number 15. Who issues real estate licenses in California? A. Department of Finance. B. California Association of Realtors. C. Department of Real Estate. D. City Licensing Board? The correct answer is C. In California, the Department of Real Estate, or DRE, is the agency that processes license applications, administers exams, and issues licenses. They're the official gatekeeper for anyone entering the real estate profession. Let's clear up the rest. Might sound important, but the Department of Finance deals with budgeting and taxes, not about real estate licenses. B is a professional organization that supports agents, but it doesn't have the legal power to issue licenses. D sounds local. But real estate licenses in California are handled at the state level, not by individual cities. So if you're getting a license, all roads lead to the DRE. Question number 16. When must an agent disclose their license status in California? A. Only at closing. B. Only in person. C. In all advertising and solicitations. D. Only to other agents. The correct answer is C. In California, anytime a licensed real estate agent advertises or promotes their services, whether that's on a business card, a website, a flyer, or even a social media post, they are legally required to disclose their license status. That means including the word realtor or their license number depending on the context. It's all about transparency and protecting the public. Now for the other choices. A is too late. By the time you reach closing, the client should already know who you are and that you're licensed. B is incorrect because disclosure is required in both in-person and written formats. D is not enough. Disclosure isn't just between professionals. It's for the public. So the rule is simple. If you're advertising real estate services, your license identity must be crystal clear. Question number 17. What form is required to identify who the agent represents? A. Transfer disclosure statement. B. Natural hazard disclosure. C. Agency disclosure. D. Listing agreement. The correct answer is C. The agency disclosure form is used to explain who the agent represents in a real estate transaction, whether it's the buyer, the seller, or both. This form lays it out in writing so everyone is on the same page. It's required early in the relationship, not at the end of the deal. Let's look at the other options. A is a disclosure about property conditions from the seller, not about agency relationships. B relates to natural hazards, like fire or flood zones, not who the agent works for. D is a contract between a seller and a listing agent, but it doesn't fulfill the legal requirement for agency disclosure to buyers. So just remember, if the question is about clarifying loyalty and representation, agency disclosure is the right move. Question number 18. What is the maximum amount a licensee can receive from the recovery fund? A. $25,000. B. $50,000. C. $100,000. D. Unlimited. The correct answer is B. In California, the Consumer Recovery Account helps protect the public if they suffer financial loss because of fraud or misrepresentation by a licensed agent. The most someone can recover from the fund for a single transaction is $50,000, and the cap per licensee is $250,000 total. Now let's break down the other answers. A is too low, because $25,000 would not fully cover what the fund allows. C sounds good, but it's higher than what the law allows for one transaction. D is definitely wrong. The fund is not unlimited. It has clear limits to prevent abuse. If you see a question about the recovery fund, remember these two numbers: $50,000 per transaction, $250,000 total per licensee. Question number 19. What is the penalty for practicing real estate without a license in California? A. No penalty. B. Fine only. C. Civil citation. D. Misdemeanor with fines or jail time. The correct answer is D. Practicing real estate without a license is a serious offense in California. It is considered a criminal misdemeanor, and penalties can include both fines and jail time. The state takes this very seriously because unlicensed activity puts consumers at risk. Let's look at the wrong answers. A is clearly incorrect because there is absolutely a penalty appearing in the question. B with fine only is only partly true. Fines are possible, but so is jail time. About the option C, civil citation makes it sound like a parking ticket. The penalty is much more serious than that. No license means no business. If someone gets caught practicing without one, they could be facing criminal charges. Question number 20. What is the purpose of the Homestead Declaration in California? A. To lower property taxes. B. To avoid probate. C. To delay foreclosure. D. To protect equity from some creditors. The correct answer is D. The Homestead Declaration helps homeowners in California protect a portion of the equity in their primary residence from certain types of creditors. It doesn't stop foreclosure, and it doesn't prevent all debts, but it can shield some of your home's value in the event of lawsuits or collections. Now, for the other choices, A is incorrect because property taxes are handled through exemptions, like the homeowner's exemption, not the Homestead Declaration. B is off track because probate deals with transferring property after death, not protecting it from creditors while you're alive. C is a common mix-up, but the Homestead Law does not prevent foreclosure from things like mortgage defaults. So here's a good way to remember it. Homestead Declaration equals limited protection for your home's equity. Question number 21. What is the annual property tax on a home assessed at $300,000 with a tax rate of 1.25%? A. $2,500. B. $3,000. C. $3,750. D. $4,000. The correct answer is C. To solve this, just multiply the assessed value by the tax rate. $300,000 times 0.0125 equals $3,750. This is a basic math question that comes up often, so it's worth practicing. Let's break down the wrong choices. A is too low. That would be the correct amount if the tax rate were closer to 0.8%. B is what you get if you use a 1% tax rate, but not what the question asked. D is too high. That would mean a higher tax rate, probably around 1.33%. Remember this. Multiply the assessed value by the tax rate as a decimal. And don't forget to double-check the math. Question number 22. Which of the following is true about commissions in California? A. They are set by law. B. They are set by the MLS. C. They are based on county ordinance. D. They are negotiable between broker and client. The correct answer is D. In California, commissions are always negotiable. There is no fixed rate, no government rule, and no standard set by the MLS. The commission amount is something the broker and the client agree on, usually written into the listing agreement. Let's review the incorrect answers. A is a common myth. No law sets a fixed percentage. If there were, that would be considered price fixing. B sounds plausible, but the MLS has no authority to set commission rates. C is incorrect because local ordinances do not control commissions. The big idea here is this. Real estate commissions are a private agreement, not a government mandate. Question number 23. What is a material fact in a real estate transaction? A. The listing price. B. The seller's reason to move. C. A minor scratch. D. Structural damage or zoning violations. The correct answer is D. A material fact is anything that could affect a buyer's decision to buy or how much to offer. That includes serious issues like foundation problems, unpermitted additions, or code violations. If it impacts the value, desirability, or intended use of the property, it needs to be disclosed. Now for the wrong answers. A is not a material fact because the listing price is just a seller's asking price. It's negotiable and public. B might be interesting, but personal reasons for moving are not material to the condition or use of the property. C is too minor. A cosmetic issue like a scratch would not impact a buyer's decision in a significant way. What is the key to this question? If it changes how someone views the property or what they're willing to pay, it's probably a material fact. Question number 24. How is commission calculated on a property sale of $500,000 with a 5% rate? A. $2,500. B. $10,000. C. $25,000. D. $50,000. The correct answer is C. To calculate commission, multiply the sale price by the commission rate. In this case, 500,000 times 0.05 equals $25,000. This is straightforward math, but it's easy to rush and make a mistake under pressure. Let's go over the wrong options. A is what you get if you multiply only part of the amount, maybe 10% of the correct answer. B is only 2% of the sale price. D is 10%, which is much higher than the commission rate in this question. So just remember that sale price times commission rate gives you the total commission. Easy and fast if you stay calm. Question number 25. What is the subdivided lands law? A. Law for commercial zoning. B. Rule for tax assessments. C. Lion placement law. D. Law governing lot sales and disclosures. The correct answer is D. The subdivided lands law is a California law that regulates how subdivided lots are sold, especially in large developments. Its main goal is to make sure buyers get full and fair disclosure before buying land in a subdivision. This helps prevent fraud and ensures that the lots being sold meet state and local standards. Let's go through the wrong answers. A deals with zoning for commercial properties, not subdivisions. B is related to how properties are taxed, not how land is sold. C has to do with legal claims on property, which is unrelated to subdivision disclosure. Here is the last takeaway for you. If the question involves disclosures for land sales or subdividing lots, the subdivided lands law is your answer. And that wraps up our 25 must-know questions for the California real estate exams. Practicing more with free real estate questions on our website. Don't forget to like, subscribe, and hit that notification bell so you don't miss any of our exam prep videos. Good luck with your studying.